All right, so welcome to Accounting for Sport Professionals. We are going to be discussing Chapter 1 of Accounting Basics. So this is our textbook, Accounting Basics, an introduction for non-accounting majors. So for those of you that are in ESS, this is a less intense version of an accounting class. So you'll learn the accounting basics. Chapter 1 is evaluating transactions. So in order to evaluate a transaction, you need to understand the basic accounting equation. So right here is the basic accounting equation. Basic accounting equation. Now this is nothing more than a simple algebraic equation. It's assets equal liabilities plus owner's equity. Now right now that's not going to mean much to you. You're not going to really understand what it is unless you've had an accounting class. But we're going to dig deeper into the basic accounting equation and you're going to understand that more. Alright? So let me get rid of this here. So within the basic accounting equation, there are certain accounts, and we're going to be discussing those accounts. So what accounting is the process of measuring, identifying, and communicating economic information about an entity or organization. So the people that use that information, the economic information, the financial information, are either internal users or external users. And we're going to be discussing two different accounting professions. So there's financial accounting and then there's managerial accounting. Now, external users use financial accounting information. So that's from the financial statements. And there's 4 different financial statements that we're going to discuss in this class. So you have a balance sheet, that's the first one, the balance sheet. You have the statement of owner's equity, statement of owner's equity. You have your cash flow statement, cash flow statement. And you have your income statement. Income statement. Fix that. Alright, so you have your balance sheet, your statement of owner's equity, your cash flow statement, and your income statement. Alright, the balance sheet. The balance sheet is a financial statement that shows an organization's assets, liabilities, and owner's equity. Owner's equity. I'm going to abbreviate owner's equity. You'll see me abbreviate owner's equity as OE continually throughout this class. So OE is owner's equity. Right, the financial statement, the balance sheet is a financial statement that shows an organization's assets, liabilities, and owner's equity at a point in time, at a specific point in time. All right, so it's not a period of time, it's a snapshot of basically a photo of the organization's assets, liabilities, and owner's equity. All right, so that is the balance sheet. So we're going to erase this. That's the balance sheet. The financial statement is the balance sheet. The statement of owner's equity can be found within the balance sheet. So that is showing what the owners hold claim to within the organization. So say you are wanting to start your own organization. You invest $20,000 into starting your organization. That $20,000 is owner's equity. So that's what the owner has invested in the company, all right? So statement of owner's equity is what the owner has invested in the organization. That's that financial statement. The cash flow statement is the statement that shows the cash flowing in and out of the organization, whether it's cash from investments, whether it's cash from other financial matters. That's the cash flow statement. Right? We're going to discuss that in more detail later on. All of these financial statements will be discussed in more detail. Now, the income statement is revenue minus expenses equals net income. Net income. Now you'll see me abbreviate net income continually throughout this class as NI. NI is net income. Right? So the income statement is revenue minus expenses equals net income. Now net income is part of owner's equity as well, and you'll see that in more detail later on. So these are the various financial statements that we'll discuss in more detail. And within these financial statements are various accounts. As I said, various accounts within the basic accounting equation. Assets equal liabilities plus owner's equity. All right, so assets. Asset accounts are accounts that are of value to the organization. So something that has monetary value to the organization. Asset accounts include cash. So cash is an asset account. Accounts receivable. So accounts receivable is an asset account. Now, accounts receivable is basically money that is owed to your organization. So if a company that you work with many times throughout the year comes to you and says, can I get a certain amount of inventory on account? I can't pay it up front. Can I get it on account and I'll pay it within the next 3 months? They owe you money, and that's accounts receivable. So that's money that is owed to the organization. You gave out the inventory, and that money is owed to you, accounts receivable. Other asset accounts include buildings, inventory. So inventory is anything that you want to sell to earn revenue, right? Inventory. So inventory is an asset account. Supplies. Anything that is of value that you use to earn that revenue. So your supplies are an asset account. Equipment. Any equipment you use that can be sold for money that you use to run your business, that is an asset account. All right, equipment. Land. And there's other asset accounts. They're intangible assets, so it means they're not tangible. So these are all tangible assets. The intangible assets are patents. So you got, let me list it here. Patent or a copyright. All right. So those are intangible assets. So these are various asset accounts. There are more, and you'll learn more as we go through the class. I just want you to better understand what an asset account is. All right, now we're going to go through liability accounts. All right, liabilities. Liabilities are things that we owe. So liability accounts would be accounts payable. So you borrowed on account to get inventory from another organization and you owe them money. So accounts payable. Accounts payable. So you owe that person money. You received inventory from them to sell your goods, and you owe them within the next 3 or 4 months for that inventory that you purchased. All right. So accounts payable, notes payable. Again, it's you owe for something that you purchased, notes payable, mortgages. Mortgage. A mortgage is a liability. So you owe that money. So anything that is owed is considered a liability, all right? So notes payable, accounts payable, a mortgage is a liability. Now, owner's equity. Owner's equity will include a capital account. So a capital account. And a capital account is what the owner has invested in the organization. The owner's equity will also have a drawing account. A drawing account. So that's any time the owner decides to take money out of the organization for their own personal use, that is a drawing account. So capital includes net income from the income statement, and it includes the owner's equity from the owner's equity statement. All right, so capital and drawing are the owner's equity accounts. All right, so those are the various accounts within the basic accounting equation, and we're going to go through those more. Now, these various accounts only happen with a single business event. And a single business event is a transaction. A transaction is a single business event. Now, a single business event is such as, it's as simple as the purchase of an item or the sale of inventory. So any event within the business is a transaction. Any event that takes place, a purchase, a sale, is a transaction. Now, these transactions are recorded in the various accounts that are within the basic accounting equation. So a transaction is a single business event, and that's something as simple as a purchase of an item or the sale of inventory is a transaction. Now, the transactions, again, are recorded within the various accounts of the basic accounting equation, and we're going to discuss those in more detail. So when a transaction is made, a single business event, when a transaction is made, it is recorded in one of the accounts under the basic accounting equation. And that account either increases or decreases. So we're going to use a storyline for this class because it's more related to sports and the sport profession. So Anne is a recent graduate. She graduated with a psychology degree, and she wants to start a facility that trains athletes. She wants to train softball athletes, baseball athletes, basketball, volleyball. She wants a facility that can train various athletes. So Anne decides to invest from her own money $35,000. So she's investing $35,000 of her own money to open this facility. So Ann's investment will go into a capital account. So capital, and it's a $35,000 investment, right? So this account increases. So this is a plus to this account. Now the other account that will be impacted is the cash account. So cash is being invested into the organization of $35,000. $35,000 is invested. So this is a plus because the cash account increased. So these two accounts increased. Ann invested $35,000. So her capital account has increased $35,000. And the cash account for the organization has increased to $35,000. So that's $35,000 invested in the company. The cash account increases and the capital account increases. So Ann will need equipment to run this facility, right? Ann's going to need some equipment. She's going to need to purchase volleyball nets, basketball hoops, pitching machines, anything that she's going to need to run this facility, right? So she invests $20,000. $20,000 she invests in equipment. So there's two asset accounts that are going to be impacted here. Two asset accounts. So we're going to take this, assets, two asset accounts. So we're going to have an equipment account being impacted, equipment. And she invested $20,000. So equipment account is increasing by $20,000, right? So our equipment asset account is increasing by $20,000. Now the other account that's being impacted is also an asset account. It's the cash account, right? Because she paid cash of $20,000 for that equipment. So $20,000 cash is being paid out for this equipment, right? So the cash account is actually decreasing. So there's less cash in the cash account than before because Ann paid $20,000 for the equipment that she purchased for her facility. All right? So the two accounts being impacted are equipment and cash, and both of those are asset accounts. So Ann needs some supplies and she needs some furniture for her facility. So she purchases supplies and furniture on account. That means that she owes for those supplies and furniture. She has not paid the cash up front. She owes that. All right, so we have our accounts payable. Remember, accounts payable, and I will abbreviate accounts payable to AP. AP will be accounts payable from now on. So accounts payable, she owes $1,500. And this is an increase in accounts payable, an increase. Now she purchased supplies and equipment, all right? So supplies and furniture. So the furniture costs $1,000, so we have a furniture account. Furniture, because it's an asset. Furniture account increases $1,000 because we now have $1,000 worth of furniture in Ann's organization. And we have supplies. We have the supply account, which increased by $500. Increased by $500. $1,000 in furniture and $500 in supplies. Now they were purchased on account. Cash was not paid, so we owe money. So it's a liability because we owe owe that organization that we purchased the supplies and furniture from $1,500. So accounts payable is a liability. We owe that money. Our furniture account increases by $1,000, and our supply account increases by $500. So Anne opens up for business, and the first day she makes $850 in revenue. Now the revenue account will be under owner's equity because that's part of net income, and net income goes into the owner's equity statement. So $850 is paid in her first week of opening up. So $850 is an increase in the revenue account, and cash was paid. So our cash account increases by $850. So the two accounts impacted are the revenue account, so revenue, and cash. Now revenue is part of, like I said, is part of the income statement. It's part of net income, so that will go into the owner's equity statement. And cash is an asset, so it will be listed under assets in the balance sheet. All right, Anne decides that she's going to pay off the money she owed under liabilities. So she owed $1,500 because she bought supplies and furniture on account. All right, so accounts payable, AP, her AP account was $1,500. She owed that money. So she decides to pay it with cash. So the cash account decreases. It decreases by $1,500, right? Because she's paying off the $1,500 that she owed to accounts payable, and it decreases from accounts payable. So the accounts payable account decreases so that she owes nothing in the end, right? She doesn't owe that $1,500 anymore. She paid the cash $1,500, and the cash account decreased. So the accounts payable decreases by $1,500, and she no longer owes that money. So we'll be discussing the basic accounting equation in a little more detail. So the basic accounting equation, assets equal liabilities plus owner's equity, means that your assets in the organization have to equal what you owe and what you have invested in the organization, all right? So if your total assets equal $7,500 and your liabilities equal $3,000, what would your owner's equity be? So in order to get that, you would have to take the $7,500 and subtract it from the $3,000. So your owner's equity would be $4,500. That's your owner's equity, right? So if your assets equal $13,000 and you don't know what your liabilities equal, but you know your owner's equity is $9,250, we have to take the $13,000 and subtract the $9,250 from the $13,000 to find out what our liabilities are. So our liabilities equals $3,750. That's what our liabilities equal. Now we don't know what the assets equal, but we know that our liabilities are $24,500 and our owner's equity is $45,000. You take those two, add them together, and we find that our assets equal $69,500. Right? We add these two together to get what our assets equal. So the basic accounting equation always has to equal out. So all of the asset accounts, all of the liability accounts, and all of the accounts under owner's equity have to equal.